Um, Welcome to Apple's financial statement modeling. In this video, I will do the integrated three-statement financial model for Apple by taking the most recent year's annual report, which is 2025 annual report, as a baseline version. From there, I'll try to predict what is the numbers for the next 5 years. By end of this video, what we will achieve is this: an integrated model which forecasted income statement for next 5 years, forecasted balance sheet for next 5 years, and cash flow statement predicted for next 5 years. On top of it, wherever needed, I have built a schedule like property, plant, and equipment schedule, revolver analysis, and commercial paper analysis. Then I also performed sensitivity analysis. That is, I've considered three cases like bull case, street case, and bear case. Say right now I'm in street case. If I switch from street case to bear case, you could see all the numbers change. Say right now, based on my street case analysis, 2026 net income is $122 billion. If I just switch from here to bear case, it just says $94 billion. So that way, we will develop this entire integrated financial statement modeling right from the scratch using an Excel. And yeah, let's keep ourselves moving. And I hope you enjoy this couple of hours long video. Okay, to start with first, let's get the Apple's most recent year's annual report. So I am in Apple's investors relations page. In this, the most recent annual report, which is for the year 2025, was published in October 31st of 2025. So I'm going to take this one annual report to get the historical data for the last 3 years. Um, might be already. So typically, once to start with the financial statement model, we'll start with the income statement. So now this page gives us the last 3 years annual report of, last 3 years income statement for Apple. So let's first input this historical data into our financial statement model workbook. From here, uh, let's try to take some assumptions and try to project the income statement for the next 5 years. So to start with, I'll just open a blank Excel workbook and then start providing the historical data. So here might be if it let's take a moment to understand how the income statement is structured. First, they have the top line revenue or total net sales, and Apple have given the net sale by products and service. Might be if you are invested or might have read this income statement before, might be products as in Apple have their iPhones, Mac, iPad, and wearables and accessories. All the four segments will come under products. Yeah. And if we talk about services, like in services is a huge thing for Apple. They have advertising, Apple Care, cloud service, digital content. Within the digital content, the Apple Arcade, Apple Fitness, Apple News, Apple Music, everything will fit in, and then payment service. So this is how they have splitted their income statement. So accordingly, even while we do our financial statement model as well, let's consider the same structure so that even our forecasting year, let's try to forecast how much they can make by products and how much they can make by service. So that way we will get to the total net sales and eventually we'll get to the downstream data. So first let's start putting the historical data. First is the income statement as usual. SDA. Okay. So to start with the income statement, might be let's make this year. So we have the data for 2023, 2024, and 2025. So it is 2023 actuals, 2024 actuals, and 2025 actuals. So these are the 3 years which we have the data for. For these 3 years, let's try to provide our inputs. I will start by product net sales and services net sales, and then total net sales. I'm just going to take this 3 line item. Maybe I just added as a net sales next to the product. And similarly, we have cost of sales, or sometimes it's referred as cost of goods sold, or COGS. Maybe I'll just use the word COGS for short form here. Similarly, I'm going to give service COGS. Then the next one is total COGS, and then gross margin. Okay. Then the next one is operating expense. In operating expense, this line is just an empty line item. Then in operating expense, they are giving two line items. One is research and development, R&D, and then the typical selling, general and administrative. So I'll just put research and CA or CH, and development, selling, general and administrative as the next line item. Okay. Then the next line item they have is total operational expense. Then next line item they have is the operating income. Let's just have this one. And then other income slash expense. Then the next one is income before provision of income tax, or we call as taxable income. I will just put as income. Maybe I'll just use the same word so that it will be simple if I look later for income tax. And then finally, next one is provision of income tax, which is how much Apple have paid as income tax for those years. Income tax, and then the next line item is net income. Finally, so maybe I'll just need total net sales. I'll just bold some of the items which I might, or I will look eventually a lot more in this video. Okay, so with this information, now let's just copy paste this data from the income statement. Might be, I know this is not the productive thing, but let's do it so that it will be easier. Just before starting inputting the data, maybe I'll just format this as the structure I would like, so that it will be easier for me. Let me do this. No, there might be a lot of Excel gurus. They will do this formatting in a better way, but I just use the old school still actions to make the formatting. Okay, so now let's start putting this data. So we are seeing Apple have generated $298.085 billion in the product sales. Let's start typing that out. 085. I think I made one typo. 2980. And then in products they made 85,200. Then for 2022 they made 96,169 here, and 109,158. Then 307,003, 294, 866. Okay. Then total net sales is just sum of these two items. Then products cost of sales, or cost of goods sales. In the year 2023, they have spent 189,282. Like, please note all the numbers here are in millions, because pretty much the income statement, balance sheet, and cash flow statement, Apple will report in $1 million. Then for the year 2024, they have generated up to $185 billion. Then in 2025, it is $194 billion. Then for the service, they have made 24 billion. Not made, like they spent, or that's their COGS. 25,119 and 26,844. Then total COGS is nothing but sum of these two guys. Then gross margin. So it's the difference between our total revenue and this one. Now let's ensure we got the right gross margin. For 2023, it says 169,148. We got this right. Next, it says 186,83. We got it right. Then it's 195,201. Perfect. Then let's go to the research and development. Research and development for 2023 is 29,915, and then 31370, then 34550. Then the SGA or selling general administrative expenses 932, 26097, 27601. Then total operational expenses, sum of these two guys. Then operating income is nothing but difference between the gross margin and total operational expense. This gives us here. Then next one, other income. Might be this is where I just wanted to take a time and talk about other income or expense. Might be till the operational income, all the line items are pretty much same, or all the items are pretty much standard, and we know what these items are. But as part of other income or expense, might be if you read through this 2025 Apple's annual report, they didn't give a breakdown of what the other income or expenses. Might be I'll show you what I mean. For this, I will show you the previous year's Apple's annual report. Say might be I'll go to 2023. In 2023, I'll go to the annual report. This is the 10K. I will open this one and just type in the same thing, other income. Okay, other income or expense, we can say in the year 2023, they have negative 565, and in the year 2022, negative 334. Might be if I just look for this footnotes in other income, might be I'll just type in, go next. Okay, here there is a footnotes. The following table shows the detail of other income or expense net of 2023, 2022, and 2021. Here, the $565 million, which they have negative value, it shows their interest and dividend income is approximately $3.75 billion. Their interest expense is $3.93 billion, and their other income or expense, this is a minor value, which is approximately $382 million. So this level of detailed footnotes, unfortunately, is missing in the most recent years Apple's annual report. So typically, this two line items, I mean, out of the three line items here, which is interest and dividend income, interest expense, these two line items are pretty much important, because by end of the day, while we complete our financial statement model, we will get to know how much cash the company had in that year. For that cash, how much interest they have generated, and we also will get to know how much debt they had, and for that debt, how much interest expense they paid. Might be since for the year 2025 they haven't gave that detailed footnotes. We'll just take an assumption. Might be it might not be that 100% accurate or the best way to do it, but I don't want to take any assumption which might be entirely off the track and make my model not close to the reality one. So for my sake of simplicity, I will just consider the other income or an expense as one line item, like not taking any assumption or guess on what is the interest income, what is the interest expense, and what is the real actual other income. So that's how I'm going to do my forecasting. Just take a straight line forecast for the upcoming years as well. So now coming back to where we left, other income or expense in the year 2023, they have lost minus 565. Then in the year 2269, and then 321. Then finally, this is the taxable income, which is not this one, this number plus this number. Okay. Then the next one is provision for income tax, which is for the year 2023, they paid 16741. Then the year next year 29,749. Then 2711. Then finally, the net income is taxable income and difference between the taxable income and the income tax. Okay, might be before I lose the changes, I'll first save this progress. In this one, I will just say Apple sum 1. Okay. So now pretty much whatever we did is just copying the historical data from the Apple's income statement. Might be right before we jump on to do the forecasting, let's take some margin rates and what is the year-on-year growth rate. Might be What I would be specifically interested is what is the revenue growth. Might be you will get to know why I need this one. Revenue growth is nothing but year over the year for the last 3 years, how much revenue they have generated more, or what is the revenue growth. Then the next one is might be this one. I haven't. I mean, it's not common. I've seen in much models, but I would also like to know how much of the total revenue is from the product's net sales and how much of the Apple's total revenue is from the service. So for that, what I'll do is products revenue contribution, which is nothing but I'll divide the product's total sales by the Apple's total sales. Then similarly, what I'll do is service revenue contribution. Or might be, if you go for any other company like Google or others, they might have 4 or 5 different revenue segments. As a best practice, or even for me to have a very clear picture, I would like to break it down by a revenue segment and understand how much each and every revenue segment has contributed. So once this is done, then similarly I will do products COGS and then service COGS, service COGS, which is nothing but out of the total COGS, how much, I mean, what is the COGS for specifically for product and how much COGS is specifically for services. Might be a small type. Okay, then next one is total COGS, then gross margin. Then next one I would need is R&D as percentage of total revenue. Then next one is SGA as percentage of total revenue. Then total operational expense. Then operating income. Then this is basically the taxable income or EBIT, which I think I wouldn't need much, but I'll need tax rate. And then finally net margin or net income margin. Okay, so let's do for these numbers, what is the calculation? Might be all these things I would need it in percentage, so might be I'll just do the format cells. Oops, I don't know why I opened this. I need to change this from number to percentage. That's what I need to do. Okay, so first thing for the revenue growth, I need to compare what is the previous year revenue growth. I mean, previous year revenue with this year revenue and do the calculation. But for 2023, we can't calculate the revenue growth because we don't have our 2022 revenue. So I'll just black this out because we won't get this value. But we can do this for 2024 revenue growth. So I'll just do difference between the, sorry, not this one. We need difference between the total revenue, then divided by this grade. Okay. It is 2% revenue growth, and in 2025 it is 6% revenue growth, which is fine. Then might be rest of these things I will do it again. I mean, I'll do it quickly. So my revenue contribution from product is dividing this by this number, and then service contribution is this one, which is this number divided by this number. Okay. So if you just take a look at these numbers, what we can see is in 2023, 77% of Apple's total revenue came from products, but in the most recent year, 2025, it is just 73%. Vice versa, the 2023 service contribution is 22%, but in the most recent year, it's just 26%. Also, if you could have analyzed the fundamentals of Apple for the last few years, you could see Apple's contribution from service segment is increasing day by day. I mean, increasing year over year consistently, whereas Apple's reliability on the product is reducing year over year to a considerable amount. For me, it's a good sign, which means that Apple is no longer just dependent on predominantly their iPhone sales. Their service sector is also taking it up. And the next one, the cost of goods sold for the product, which is to make, I mean, Very basic thing, right? To make $298 billion of revenue in the products segment, they have spent $189 billion. So let's do this, divide this by this guy, and we can see 63%. That is, to make a revenue of $100 in a product segment, they are spending like $63.5 on the year 2023, and this number pretty much stayed constant, so it didn't go up. But the good thing is, when it's come to service sector, you could see that difference. Okay, in the year of 2023, their COGS service is 29.17%, which is, to make a revenue of $100, they spent approximately $29 in the service. But considerably in the next 2 years, it has reduced to just 24.59, which is, to make $100 of revenue, they are just spending 24 or $25 in the COGS. This is one of the best thing, because whenever the company is moving from a hardware to a software, that is, in this case, hardware as in I mean the product, like iPhone, Mac, and software as in, like, I mean all the Apple service, like which we saw before, like advertising, Apple Care, and Apple Payment, others, the COGS will be very low. So that's why that's the same thing which is being signified here. And I really hope that in the upcoming years, the COGS of services will even go lesser. Might be we will try to accommodate that consideration into our model and build it accordingly. Then next one is total COGS. That is this number divided by this number. Then this is what we need. And then gross margin. Gross margin is nothing but our this number divided by this. I'm just thinking technically, if we add up the COGS percentage and gross margin percentage, it should come up to 100. So I really don't think I would use the COGS much in this, so I'll just delete this as well. Then R&D as percentage of revenue. So this is the R&D and the total revenues here, and then I will just project it for the next 3 years. Then similarly, SGA. This is this SGA expense divided by total revenue. This is 6.5%. Okay. If you see R&D as part of total revenue, it was 7.8% in 2023, and slightly increased to 8.3. Might be, I'm assuming all the spend is due to this AI thing. Compared to other top 5 or 6 company, Apple is considerably spending less, but still the number is considerably higher. I mean, it's on the increasing side. Then if you take a look at the SGA, it is same around that 6.5, or that might be 6 to 6.5 percentage. So I think it's pretty much staying constant. Then total operational expense is nothing. I don't think I need the total operational expense as well. I will remove this, or let me have that as well, just in case if I need any. So just, or the easier way is to do this one, this divided by this. I think I messed it up. It's actually this number divided by this number. Okay, so long story short, their operational expense is around 15%. Then operating income, dividing the operating income by this total net sales, which is 29% in 2023, 24% in 31% in 2024, and in the most recent year it's 31.97. Then finally, tax rate. Might be, just to be very clear, tax rate, we need to divide the tax paid by the taxable income, which is this number. Might be, while even I started understanding this accounts, I do go by the total revenue. So the tax rate is 14.7% in 2023. In 2024, it's 24%, is way beyond the tax rate in the US. Then in 2025, it is 15.6%, which is fine. Then finally, net income at the margin. I will divide this number by this number, and I will get this one. I'm not sure why I'm saying, maybe this should be a percentage. Okay, perfect. So now we got all this data. Now let's start projecting what is the historical numbers. I will put 2026 predicted, 2027 predicted, 2028. Okay, well, just And this one. Okay. So, how can we get this future projections? Might be there are a lot of data providers like FMP, API, Alpha Vantage, where they give what is the analyst prediction for the next subsequent years. But for this video, I will use an application where without we needing, without we needing to pay some additional amount, we can try to understand what is the analyst estimate. That is nothing but simple Wall Street or simply Wall Street. So you come here, you can just create your login. Might be for the free tier, you don't need to pay anything. For the free tier itself, you can see up to 5 companies per week, if I'm not wrong. So in this, type in the company name which you need, and for all the companies, there will be like these many subsections. Here you just come to the future growth. In the future growth, it says earnings and revenue growth forecast. So you could see this has all the revenues, I think even for the past one, and it is for September 26, 2025. Then it also says for year 2026, 2027, and 2028. So we will just take the input of the forecasted revenue for the next 3 years from this website. Might be this is just a starting point I will just take. But what I would do is by end of this video, I will also try to do my analysis. It might not be um, entirely accurate, but based on what I have an understanding of Apple's business model, I will break it down the revenue by products. Within the products, they have 4 segments, and I will try to forecast for each and every segment how much they will be able to make it in the subsequent years. By end of this video, I'll just input that number. But for now, to keep ourselves going, let's try to take the number from this website for the next 3 years and keep ourselves going. So what it says is for the year 2026, the total revenue is $452 billion. So we'll just type in that number. Please note this is total net sales. Please be careful while you input the numbers here. So it is 452. What's the number? 452 511. And let's see. Yeah, it says 2025, September 2025. There the total revenue is at $416 billion. That's the same number we have. Okay, then let's see for 2027. What is the number? 2027, it is $480 billion. 480, 437. Then in the year 2028, it is 510 billion 397. 510 397. Okay. So this is the information we have. But whenever we do the financial modeling or I do the financial modeling, as a best practice, I will take for the forecast for 5 years. But this provider or simply Wall Street have only 3 years of forecast. There is some other providers which I use, which is paid one, that has forecast for 5 years. But just for sake of simplicity, I'll take a simple assumption um, that I'll just get 3 years. From here, what I would do is simple. So here, what we did is revenue growth for year over year. We have calculated for the year 2024 and 2025 what is the revenue growth. Now we since have the revenue for the next 3 years, we will just try to forecast or just calculate what is the forecasted revenue growth for each year in the next 5 years. As per the number provided by Simply Wall Street, it says there will be 8% revenue growth in 2026, and it will be 6% of revenue growth in 2027, and in 2028 it will be 6.24%. Looking at this number, I will take a simple assumption that in the 2029 and 2020, in 2030, Apple revenue will grow by 6%. With this assumption, we can calculate the total revenue. That is 2028 revenue multiplied by this number. Then similarly, I will do the same. I don't want to hard code it. So this is how we are predicting it, or might be, if you think that Apple might not grow at a 6% year over year in the 2028, we can just change it. Or as I mentioned, I'll show you how I will calculate to a close extent. Might be this number might not be exactly the same, but I feel much more confident or reliable in the way I do calculate. So this is the first step which we have did it. Then next one, how I calculate this revenue and services. As I have mentioned, Apple's revenue contribution from product is considerably getting lower, and Apple's service contribution is getting increased. So that I'll try to forecast the same. Might be I will just use a step function or nothing, but I will take an assumption that Apple's revenue from product will decline, or total contribution of Apple's product revenue will reduce 1.5 percentage for each and every year, and Apple's service contribution will increase by 1.5 percentage for every year. So that I'll take this assumption and try to populate the numbers. So maybe I will just take a note as step function, or maybe you can just call us any better word you need, but I'll just put a step function. So what I do is I will just use this number and subtract it by this number, and I'll just anchor it. Then pull it forward. Then do the same, but increase it here and anchor it. Okay. So now this is what we are seeing as Apple's contribution from product and contribution from service. So now with this number, let's try to fill, with this percentage split of service and product, let's try to fill this numbers up here. So product will be this number multiplied by this number, and then this thing up here, then this number multiplied by this number. Okay, we are good. So just as a sanity, if we just add these two, this number should come up 573,482. That's the exact number, and we'll do a sanity check on another spot as well. 510,397. Okay, we are good for now. Then might be, I think I'll increase this. Okay. Then the next one is product COGS. Even the product COGS, we need to understand how much it will be. But looking at the last 3 years historical data, it is around 63%. So I would assume this as, maybe I'll take a note. Assume last 3 years average. And for this two items, it is a step function. I will just put this here, so that once I revisit this document after a year, I will know from where I got this numbers from. So the product COGS, I will take what was the average for the last 3 years, and I will do this same number. Okay. Or even if you think, there might be, recently Apple moved their production unit from China to India. If you think that will either anyway increase or reduce the COGS of product, you can provide it. But for now, I'm just taking a simple assumption that will remain the same for the last average of last 3 years. Then service COGS might be, in my opinion, the cost of goods sold for service will reduce consistently over the next period of years. Because if you look at some other companies which provides softwares, say, or an application, say if it is an example of Meta's gross margin is consistently around 80 to 85%. So what I'm going to consider is service COGS for the last 3 years, it has reduced from 29% to 24%. I'm considering still it will reduce by 1 or 1.2. I would consider 1.25% for the next 5 years. So what I will do is I will do the step function. Maybe FUN doesn't look great, but I will just add it. See, okay. Then I will do 1.25%. So what I'm going to say is Apple's service COGS will reduce by 1.25% for the next 5 years. Or if you think it can not go by 1.25, just 1%, or even you could just do the same. But I think 1.25 is reasonable, but still, just to be on a safer side, let's consider there might be adding a lot more functionalities. There will be a lot of spend. So let's consider 1%. So with this, now let's try to fill what is the actual dollar for product COGS and the service COGS. So this is this number multiplied by this number, and then forecast it. Then services, this number multiplied by this number, and then total COGS is nothing but summation of these two guys, and then the gross margin is also nothing but summation of these two guys. I mean summation of, sorry, gross margin is difference between the total net sales and the total COGS. So with this, let's calculate our gross margin here. So what we are seeing from the numbers here is, if we are going by our assumptions, Apple's gross margin, which was around 46% in 2025, it will grow up to 51.52%. This is based upon our assumptions. Then let's see what will be the case for the R&D aspect of total revenue, R&D percentage. Right now this AI thing happening, a lot of companies are investing a lot in AI, and might be Apple is also investing in research and development. I will again consider the simple assumption as before, that they will be spending the last 3 years average of R&D percentage of total revenue in the next 5 years as well. So I'll just copy paste this assumption. Might be I will do the same assumption for SGA. Or if you think that Apple will go all bang on for the next 5 years in R&D, you can even consider a step function and increase it by, say, right now it's 8.3. Next year it might be like, say, 8.5% or 10% or whatever. You can increase it. But for a safer assumption, I will just consider average of last 3 years. Average of last 3 years for this guys, and then this guy, and then this. Then similarly, SGA expense. Oops, I don't know why my brightness was too low. I just increased it. My apologize. Okay. Then this guy will come up to this number, and I will just consider it will be just 6.6%. Okay. Now since we got this number, we will fill it. We are saying R&D expense will be 8.04% of total revenue. We'll just get this number. Then SGA is 6.6% of total revenue. We will get this number. Then total operational expense is this number. Then operational income is just this number. I will just forecast our operational expense and then operational income. Okay, we got this number. Then other income or expense, as I mentioned before, in the 2023 report, there was a detailed breakdown which gives interest income, interest expense, and other discretionary income. But since we didn't have this information in 2025 and 2024, I'm just going to straight line this one. It might not be the accurate thing, but still, for sake of consideration, I'm just going to do the straight line assumption. And I'll just take a note. Assumption, straight line from 2025. Then finally, income before provision for income tax. This is nothing but we already have it, summation of these two things. Or even I would say this one, right? Since this is very minimal, I mean, it's 500 million, even though it's a huge amount compared to the revenue what Apple generates, the number is very minimal. So I would even consider there is no other income or expense. I'll just put everything as 0. Might be it's not a best practice to hard code it, but just for our assumption, I mean our use case, we are just doing it. And then the assumption, no other income or expense. Okay. Then what we need to do is provision for income tax. If you do the income tax, might be for the last 3 years average, you could see it is 18.14%. We can take this number, but this number might not be accurate. The reason is we know for the corporate the maximum tax rate is 21%, and pretty much historically, if you see a lot of corporates, they pay the tax around 15 to 16%. So in my opinion, uh, taking 18% for a company like Apple will be too much. So I will assume 16% as a tax rate for the next 5 years. Yes, of course, it might increase or reduce to an extent, but still, for our understanding, for our progress, I'll consider it as 16% for next 5 years. Assume 16% tax rate for next 5 years. Okay. So now let's calculate what is the tax. What is the tax which Apple will be paying for the next 5 years? We know they will pay 16% of their taxable income, which is this number. So let's forecast this. That's done. Then net income, we will finally get it by just expanding. And finally, your net income. I don't need to do anything. I'll just drag and drop. Perfect. So if we see what is the story which you're going to say for the net income is 27. It was 26.92 percentage in the year 2025, and eventually it will grow up to 30.97 percentage as their net income margin the 2030. Might be it is a significant growth in the next 5 years. We are saying the net margin will grow from 27% to 31 percentage, but that's my assumption. Or if you could say that, what, the service might not even grow for the next 5 years, only their revenue will come from products, then this number might entirely change. But still, I will stick to my assumptions for this statement modeling, and I hope Apple comes close to this margin, because if it comes to the margin, it will be better, and their stock will also be trading at a good valuation. So I think we just completed the first step of the financial statement model, that is, provided the income statement input and took our best assumptions to forecast for the next 5 years. Then, as a next part, we'll continue to do the same for the balance sheet. Like, first, let's input the historical data. Then, using the historical data, let's try to forecast for the next 5 years. Okay, now let's get started with forecasting the balance sheet. Might be just before forecasting, let's try to provide the or input the historical number, and then try to take our educated guess for what would be the forecasted percentage for each and every line item, then keep ourselves moving. So to take a look at how the balance sheet of Apple is reported, this is again the same 2025 annual report. As usual, as a very basic thing, balance sheet will be divided into three sections: assets, liabilities, and then shareholder equities. So in the assets, they have cash and cash equivalents, standard one. Marketable securities might be cash is just the cash sitting in their bank account. Cash equivalents might be a distinction as like treasury bills, which will be maturing within like 90 days of this reported period. Then marketable securities are something which will be maturing if it is a treasury bill or T bonds within a year, or if they have any other equity holdings which can be sold within a period of time. That's the marketable security. Then accounts receivable. This is how much funds or how much cash the companies expect to generate back or receive back from their suppliers or the customers. Then vendor non-trade receivable. This is kind of the cash or the funds which the company is expected to receive from the vendor due to the non-trade things. As in, they might have had agreements with the vendor that if they achieve a certain set of volume of metrics, they will receive certain cash back to the company. So that kind of non-trade receivables, Apple have reported. Then finally, inventories, and then other current assets. So all these six line items contribute as total current assets. Then in non-current assets, or in other words, it's called as a long-term assets. Again, marketable security, which will be beyond a period of year, and then property, plant, equipment, or PPE, then other non-current assets. These sections contribute to non-current assets. Then summation of the total current assets and non-current assets, we will get the total assets. Similarly, in the liabilities, the first one is accounts payable. That is the cash which Apple as a company need to pay to their suppliers or vendors for the products they have received, products or service they have received. Then next one is other current liabilities, that is within 1 year, whatever liable they have provided that as a line item. Then deferred revenue. Then next one is commercial paper. Commercial paper is just short-term borrowing, which is less than 270 days. Then term debt, which is that, or sometimes it's called as short-term debt or current portion of long-term debt. All the items will be included. That is the term debt here. Then in the non-current liabilities, we have term debt. Again, to be very clear, it's called as also long-term debt. Then other non-current liabilities. So these sections contribute to the total liabilities. Then coming to stakeholder equity, standard three line item, common stock and APIC, accumulated deficit might be here you see these numbers are negative, but most of I mean some other company, if you take a look at, they have a positive value here where they call it as retained earnings as well. In this case, it's accumulated deficit. If the value is positive, it is earnings. Then finally, accumulated other comprehensive loss. These three items contribute to the total shareholders equity. So now first let's try to input these numbers into our Excel. Might be I'm just going to type in these numbers as is. So might be what I will do is I will cut the video here, then I will restart once I start inputting or start forecasting the numbers, so that it will save some portion of the time. Okay, so now what I did is I just provided the last 2 years historical data of the balance sheet. The only thing what I did here is in the balance sheet we have section as total current assets, total non-current assets. To be honest, while I do the financial statement modeling, that split is not required. So I consider all the total assets as one line item and all the total liability as one line item. Then shareholder equity, there is nothing much, just the three line items I have considered this. Then might be the most crucial part of doing this financial statement modeling is ensuring the model balances well. That is, the total assets of the company should match with total liability plus the shareholder equity. So, or commonly it's referred as a balance check whenever we do a financial statement model. So I'll just add one line item here as balance check. And what it need to do is, once we calculate the, I mean, right now this should match, that is difference between the total assets and the total liabilities and the shareholder equity. I think I made some mistake here. It's not matching. Let me come down. Okay, I think I have made a very usual mistake I do a lot of times while copy pasting these numbers. I think I just flipped something. Let me do a quick check. Okay, for 2025 it is 93,568. So technically this number should go here, and then this number 83276 minus 19154 minus 172. This number should come here. Might be, while you just type in the historical numbers, just be careful. Might be just missing whatever the number in the previous year will copy paste in this year. That issue most likely will happen. So coming back to what I was saying, we will do the balance check. Balance check is just difference between the total assets, total liabilities, and the shareholder equity should come to zero. By end of the day, that's where you are sure that, or you're confident that whatever numbers you are giving in into the historical data or the forecasted data makes sense. So maybe I'll also add one more thing here. I'll just add a round function here, round off these three difference and tie it to three digits. The reason why I do this is, might be once we start forecasting the numbers, a lot of numbers will come in the decimals. While the number comes in decimal, there might be a small rounding up error will most likely happen. So to avoid that, I just use the round function. So now, since we have already captured all the informations or the historical information, let's try to start taking our assumptions for the next 5 years for each line item and try to complete this balance sheet. So to start with, the first line item is cash and cash equivalents. Typically, this cash and cash equivalents by end of a day, um, we will get from the cash flow statement, because if you read through the any cash flow statement, the last line item in the cash flow statement is how much cash the company have generated in the year. So what will be typically done is we will take the previous year cash which the company had, in this case which is $35 billion, then add the cash which was generated in the year 2026, which you are going to estimate. Since that will come only once we start doing our cash flow statement, right now I will not touch anything on the cash and cash equivalents. So might be I'll just use some color coding so that we know these kind of or these items we will come back and revisit and update, or commonly we'll call it as building a schedules for each and everything. That let's come to that later part of this video. Then marketable security. So marketable security is nothing but the short term holdings which the company had, where they can dilute it within a year. To be honest, whenever I do the financial statement modeling, I don't try to increase this marketable security value anymore, because we are not sure whether the company will try to have more marketable security in hand. Might be historically seeing Apple has a lot of things, but for my sake of assumption, I'm considering the marketable security which they had in 2025, which is approximately $18 billion. They will still try to hold the same amount. If not, I mean, but realistically, that will either increase or reduce. But just for our sake of assumption, let's consider they will just have the same marketable security for the year going forward. Might be I will also, as a best practice, write an assumption. Assume I will just put assumption straight line. But if you are thinking that whatever company you're trying to analyze, they can increase the marketable security or reduce it, maybe you can take that guess and accordingly update it. But for me, I think even $18 billion is a very huge amount to have it in marketable security. So I will still stick to the same number. Then account receivable. Account receivable is slightly a trickier one. I think we will, maybe as we know, account receivable is the cash the company needs to get back from their customers or their suppliers. For this, what we will do is we have the DSO, that is uh, days sales outstanding. That is how much of the revenue the company need to get back from it. I mean, how much days it takes for a company to collect the revenue which was sold in the credit. Even here, we need to exactly know how much the company sold on credit. Might be out of the say in the year 2025, Apple have total sales of $416 billion, but Apple haven't provided out of this $416 billion how much have been sold on credit. So since we don't have that information, as a proxy to calculate the total credit sales, let's take the total revenue. That is what I'm going to do now is take, first I need to calculate historically what is the DSO, then plug in that DSO for the forecasted year, then get what is the account receivable. Maybe I will write the formula so that it will be clear. So account receivable equal to DSO into revenue by the total days. Maybe it will be total days, but since we are talking about an yearly report, so I'll just put 365. So now I will start calculating what is the DSO for the last 3 years. So with this formula, we can get the DSO. DSO is nothing but account receivable. Just pull this revenue on the other side. Account receivable into revenue. Account receivable into 365 divided by the revenue. That will give us the DSO for the last 2 years. So now let's go here. Let's calculate this account receivable into 365. Divide this by the historical revenue. Then this is the same for the next year. So now with this information, we can get for the last 2 years by taking total sales as a proxy. For the total credit sales, we are seeing the DSO for Apple is 31 and 35. But technically, if we get the total credit sales, the number might slightly differ or significantly differ. But since we don't have that information, we are taking it. So now what I'm going to consider is just average these two last I mean, just average the last 2 years DSO and consider that will be the same DSO for the next forecasted year as well. So this average will come to 33 and I'll just use the same number. Okay, then now I will plug in this DSO, which we calculate as 33, multiply this by the revenue of the respective year, then divide this by 365. This way, we will get what is the accounts receivable as per our calculation. Then vendor non-trade receivables. Vendor non-trade receivable, since this is not something related to the operational, because they already clearly mentioned it's a non-trade related operational, might be more of an agreement related thing. I will assume this will grow by a straight line. That means there is neither increase nor a decrease for the next 5 years. Or you could even say, you know what, this doesn't make sense. This will go zero. That's better assumption even. But I will just consider this as a straight line growth. Then next one, inventories. So in my opinion, inventories are the raw materials which the company need to manufacture their products, or even the completed products which just sits in the inventory for the customers to come and purchase. In my opinion, it makes sense to grow this inventory with the revenue growth. So I will take that assumption. Assumption grow with revenue growth. So now we are trying to say this number multiplied by, we already know what is the revenue growth. So for the 2026, as per our data, Wall Street, simply Wall Street, we are saying 8% revenue growth. I'm using the same number. Then just forecasting the same over the next 5 years as well. The next one, other current assets. Even in my opinion, other current assets might grow with this, I mean, grow with the revenue. So I'll just use the same assumption what I did with the inventory. Just copy paste this assumption. Then grow with this. Again, where should we go for the revenue growth? That is here. And then next one, long-term marketable security. Again, as a note, which we did for the short-term marketable security, I'm just going to use the same assumption that the marketable security will remain the constant over the next period of 5 years. But if you think, or if you have a better insight of the company which you are valuing, that might or increase or reduce, you can feel free to put it. The next one is property, plant, and equipment. I think this is one of the most complicated thing, which will definitely need a deep diver to calculate how it will look like. So for now, we will keep it open. I'll just copy paste. So this color coding, we know we need to revisit this or build a separate schedule to get an idea. I don't know why my laptop is not letting me to copy the color. I will just do this. And then other non-current assets. Similar to how we did the other current asset, we assume that it will grow as per the revenue. I'm taking the same assumption here. So growing this with our revenue. Revenue is this guy. Then basically the total asset is this numbers. Okay, so now we completed the assets section. In the assets, we have two open items. One is cash and cash equivalents. That will be the end point in the cash flow statement. We'll just plug it in here. And then similarly, we have the PPE open, which we will create a separate schedule and come back to it later. Now comes to account payable. Accounts payable, similar to what we have account receivable, accounts payable is other way around. That is, the cash Apple as a business need to pay back to its suppliers or vendors. So the popular formula or the major formula which is used in accounts is to calculate accounts payable is accounts payable equal to DPO into COGS divided by 365. So similarly, how we did for the assets in the accounts receivable, first we will calculate the DPO for the historical 2 years, then use average of the historical 2 years of DPO and use the same value for the next 5 years as a DPO, then come back here and calculate what is the accounts payable. So now DPO is accounts payable in the last 2 years. Accounts payable, we already have it here, multiplied by 365 divided by COGS. COGS is this guys, it's 120. Okay. So now let's take average of these two guys and consider this number will be the same throughout for the next 5 years. So now we got the DPO, which we calculated as 118 based on the previous 2 years average. Multiply it with COGS and divide by CO 365, which will give the accounts payable which you're looking for. So multiply this guy with the COGS. COGS we have calculated is here and divided by 365. Then other current liabilities. Um, there is two ways which we can think of. Other current liability is the liabilities which the company we need to pay to the customers. Might be, in my opinion, as the business grows, the liability will also grow. The same assumption which we took, other current assets and non-current assets, we grown it with the revenue. We will again take that same assumption here and grow it with the revenue. Then this number multiplied by this number plus revenue growth is this guy. Deferred revenue. So deferred revenue, as I mentioned before, that is the part of revenue which the company already received, but they are liable to pay. So the simple thing is, I will try to consider how much the deferred revenue has been part of Apple's total revenue in the last 2 years. Take the average of that number and use the same number for the next 5 years. That's how I do. Similarly, how we did for the DS1 DPU. So what I'm trying to do here is deferred revenue divided by total revenue. So now what I'm going to do, deferred revenue is this number divided by the total revenue is this number. And then use that for the next 2 years. I don't know why it's coming zero. Okay, might be I need to see that as a percentage. So I'll just come here and make it do the percentage. So which is just 2%. Then it's nothing significant, but still, to our sake of sanity, let's take an average of those two last years and consider 2.14% of the total revenue is the deferred revenue for the next 5 years. So now let's go back, calculate this and come to our total revenue. Total revenue is here. Then okay. Next one is commercial paper. This is again the short-term borrowing for within that for the company to operate. In my opinion, this also needs a separate schedule, so I will just color code it and we will come back later. And similarly for the term debt and long-term debt, let's see what just before coming to that term debt, let's finish the other non-current liability. Other non-current liability, the same assumption as other current liability and assets, we will grow it with the revenue. So we would say this number multiply it by this number, then do this calculation. Okay. And then total liability is nothing but this guy. Okay. So now coming to this section, which is term debt. Might be once we do the term debt, non-current, or in simple words, it's long-term debt. We will try to take some assumption on the term debt current. So if you go to the Apple sheet and just type in long-term debt, no, okay, there will be a schedule for long-term debt, not this one. Then this is just a cheat code which I tried to do. So I'll show you the future principal payments. Let me also try to make sure one thing. Term debt principal. Okay. So you could see in the footnotes of term debt, there is this one breakdown which the company have given. what they have mentioned is the future principal payments for the company's notes as of September 27, 2025 are as follows, which is in 2026, they need to pay $12.3 billion. In 2027, they need to pay approximately $10 billion. In 2028, they need to pay $9.3 billion. So they have given a breakdown of what is the payment which they're expected to make. I mean, this is just a principal payment. Please make sure it's not considering any of the interest. So let's try to include this in our analysis and try to reduce how much total debt they have and reduce the principal each and every year, and then just input what is the debt which you are going to see after this. For this, let's go back to our spreadsheet and build a long-term debt schedule. And this number will just copy paste so that will be. So might be going forward, while at least specifically while we do the cash flow statement, this way of calculating this is similar. They call it as base BAC, as in which we will have 4 items. First thing is what is the beginning of period. Second thing is any addition made, and then S as in subtracting if there is any applicable. Then E is basically the end of period. So we will use the same thing here, which is beginning of period long term debt, and additional is new debt, and subtract or less the debt repayment, and end of period long term debt. So by this way, we will get to know what is the long term debt by end of each and every year. So I'll just put this one. Okay. So now we know end of period of term debt is for the last 2 years is this much. We'll just use the same number. And typically the end of year long term debt of the year 2024 will be the same as beginning of your long term debt for 2025. I'm just copy pasting this number here. Then if we need to understand what is the 2026 end of the year long term debt, which will be nothing but summation of the beginning of period debt plus any new debt taken, subtracting with the debt repayment. So right now, we didn't input any values, so that's how it should look like, but never mind, we will come back and update it later. So now, as per this schedule which is given in the term debt footnotes, we can understand that Apple is expected to pay around $12.39 billion in 2026 as part of a long-term debt principal. So we will input that number 12,393, which we will input here minus 12,393. I'm sorry, that's here minus 12,393. Then in 2027 they will pay 10,078, 178. My apologies, it should be a negative number. Then next year they will pay 9,300. Then in the year 2029 they will pay 5,235. Then they will pay minus 49,72. So now we could see that in the beginning of 2026 they had $78 billion, but as per the debt schedule which they have gave, they will pay each and every year this amount, and the number will be somewhere around $36 billion as a long-term debt by the year 2030. Whereas we haven't considered one more important factor here, that is new debt. We just consider Apple is just going to repay the interest, but what if Apple takes new debt? Might be if you follow the news, Fed is expected to cut the interest rate in the upcoming months or even upcoming years. So if that is the case, then Apple might even get interest at much lower rate. So if that is the case, they can even take say $10 billion each year as a new debt that will increase. I mean, they have a capacity to take that load. But just for our assumption, I'm just considering Apple is not taking any new debt going forward. They are just going to repay the debt. Even though, as per the schedule, if they repay the debt by end of year 2030, they'll still have $36 billion of debt outstanding. So I'm just going to go with the assumption. Now we got what will be the end of period long term debt. This number is nothing but we'll just copy paste it here. Might be just not copy paste it, directly link it here. I'll just link this number here and then come here. That's it. Okay. So now the last missing piece is term debt. Term debt, we really don't know how much it is because they haven't provided a detailed schedule as the long term debt. So the simple assumption is I will grow, I mean, not grow with the revenue, I'll just grow this as a straight line. There won't be any change in the term debt. They still have approximately $12 billion as a term debt. So this part is done. Then finally, uh, we need shareholder equity. In shareholder equity, there is three line item: common stock and APIC, which will take a moment to understand what does it constitute of. Total assets. Okay. Mm, okay. So here is the common stock APIC accumulated debt. If we scroll down, right next to the balance sheet, there will be a page that says consolidated statement of shareholder equity, which gives detail of just these three items. We could see the first point, common stock additional paid in capital, that is what is the beginning balance, that is of beginning balances of 2025, then how much common stock they have issued, that has been added, then common stock withheld related to the net share settlement of the equity, then share based compensation. These components will get you to the common stock and additional paid in capital. Then accumulated deficit is nothing but start with beginning of balance, that is last year's end period value, add net income, net out the dividends, and net out the share repurchases. This will give us the end balance. Then finally, accumulated earnings, I mean accumulated other comprehensive loss or earning. This haven't provided any breakdown. It just said one line item of other comprehensive income. So if we take a look at it, we haven't even touched to the share-based compensation now. That will come while we do the cash flow statement. And similarly, to get the accumulated deficit, we need the dividends and share repurchase. That also we will come to know when we go to the cash flow statement. So for now, I will consider this as an open item and then just consider accumulated other earnings. Even here, since we don't have a detailed description of what is constituted of, I'll just consider a straight line assumption that will make my life easier and we will go to the next step. So now going back here, just color this one, common stock, and this one, I will keep it open. Then accumulated shareholders, this is going to be this number. So I'm just going to extend the same number to the next 5 years as well. Shareholder equity summation of this, which doesn't expect. Then balance check. Balance check, typically right now you can't expect it too much because we haven't updated two line items in assets, one line item in commercial, I mean one line item in liability and two line item in the shareholder equity. So once we develop a schedule or a detailed plan on this, we will come back and update this one. So with this, the balance sheet portion is done, and now let's move to the cash flow statement of financial statement modeling. So now, when it comes to cash flow statement, it makes our life simpler because we don't need to input a lot of historical data. By end of the day, cash flow statement modeling is just reconciliation of what we did in balance sheet. So first, let's get started. So I'll just copy paste this and just change it into cash flow statement. Cash flow statement. Okay. So as we know, the cash flow statement is broken into three sections. Might be able to show you here. Okay. So cash flow statement have three major sections. One is operational income, second one is investing activity, and third one is financing activity. So let's try to build these three line items in our statement model and see how it goes. So as every cash flow statement, let's start with operational income or operational cash from operation. In that, the first one is net income. Second one is share-based compensation. And then the third one is depreciation and amortization. So I'm just taking the first three items here. Depreciation and amortization. Okay. Then if we take a look at this one, it has a lot of other items like account receivable, net vendor, non-traded receivable, net inventory, and others. All these line items which you have seen in the balance sheet. And even the section it says change in operating assets and liabilities. So to make it my life simpler, I will consider this as change in working capital assets, change in capital liability. Because by end of the day, if you see accounts receivable is in working capital, vendor non-trade receivable is in working capital. So that way I will group it and calculate what is change in the working capital assets and liability. Similarly, we also have change in non-working or long-term capital. I'll just put in liability here and I will tell you why I haven't included assets later. Then if I just do the summation of all these things, I will get cash generated from operational activity. Then I will just input change in non-working capital assets here, because by end of the day, liabilities is something which the company need to pay, but asset is something the company have purchased it. So technically it doesn't make much sense to put that in the operational activity, so I'll have it in the investment. Then the next one we can put it as the purchase of property, plant and equipment, which comes in the investment activity, purchase of PPE. Then we can say cash used in investing activity. Then finally, when it comes to the financing section, it will be simple and straightforward. The first one is dividends paid. If the company you are trying to analyze doesn't have any dividends, don't bother about adding this line item. Then share repurchase, then new debt taken, on then debt repayment, which adds up to get cash used in financing activity. So by summing up all these three items, that is cash generated from operational, cash used in investing, cash used in financing, we will get cash generated by end of the year. Okay, now let's get us going. The first line item, net income, we already forecasted the net income in the income statement, so just link it there. This guy. Then share-based compensation. So for this, let's go back to our cash flow statement and see. For the share-based compensation, they have mentioned in the year of 2023, they have spent 10.83 billion. Let's start typing that number here. Then next year, they have spent 11,688. Then 12,863. So share-based compensation, in my opinion, it will grow with the revenue growth, because as in the company grows, the most of a company they pays their employers in the share based. So the simple assumption I'm going to take is share based compensation will grow as per the revenue growth for the next 5 years. I'll just consider this one and this one. Then next one, okay, we are done with this. Then depreciation and amortization, we will try to see what was the last 3 years data. It is 11,519, 11,445, 11,698. Okay, so typically if you see this number is around the $11 billion in the same. Might be, to make my life very simple, I can just consider the depreciation and amortization will be the same or stay constant as per the previous year, but that doesn't make any sense because we have two different sections, right? One is depreciation for the property, plant, equipment, and amortization for the non-current assets. So I wouldn't calculate any historical number for depreciation and amortization right now. I will just come back after inputting all the small items, then calculate how can we put these numbers here. This is done. Then let's come back to the working capital assets. Here we'll just, for this we'll just go back to our balance sheet, calculate what are all the working capital asset which will go in here, and just calculate the difference here. So assets is nothing but the difference between the previous year and this year, but while we calculate the liability, the difference should be the current year minus previous year. Might be, if you're doing this for the first time, this logic might be confusing, but just take some time and think about it and do it carefully, or else whatever model you build, there might be a very small mistake which will lead to the model not balancing by end of the day. So now let's go to the balance sheet and figure out what are all the working capital assets. Maybe I'll just add one more line item and mark what is the working capital assets. So this one anyhow I straight lined it, so it doesn't going to make much sense. So change in working capital assets, this is change in working capital assets. This will be the change in working capital assets. So all these items will come and change in the working capital assets. Just summation of these four guys, difference between the previous year and the current year, we will get the value what we are looking for. So now I'll come here, do the summation of these four guys. I think you can do both the way, just difference between this one and this one, or do this and just add a negative symbol on top of it. Either way will work fine. I'll just keep this number. So I got this number. The next one is working capital liability. So here let's figure out what are all the items which is working capital liability. This is working capital liability. This is liability. This is working capital liability. And this one term debt, I will have a debt schedule, but since we are considered as a same, it doesn't make any difference. So now let's calculate the difference between these two guys. Sum of these three guys minus sum of these three guys. I think I made a mistake here in the formula. Okay, now I got this number. Forecast. Then finally change in non-working capital liability. There is only one line item, change in non-working capital liability. So just difference between these two guys will give me this number. Come here, difference between this guy and this guy, and do the same for the last 5 years. Now this is easier. This summation of all these items, we will get to know what is the cash generated from operational activities. So in the last year, they have mentioned they have generated $111 billion. As per our calculation, we are saying they're expected to generate 153 billion in the next year, even though it looks on the higher end, but that's how our assumptions came up. But let's stick to our assumptions now. Then in the financing segment, we have a change in non-working capital asset. Since I haven't calculated what is a depreciation and amortization, it doesn't make any sense to now come back and add this number. So I'll just do the same, just color code it and come back and visit later. Then similarly, purchase of property, plant, equipment. Now let's try to take some time and calculate how this number, or let me do one thing. No, I think I'll first also leave this one empty for now and build a schedule later so that this section of video, this part of video will be completed, and we can say the cash flow statement is done, and then we only have some schedules to build and wrap the number back. So now the cash used in investing activity is nothing but summation of these two guys. Right now we don't have any numbers, but once we come back and plug in, we'll get some numbers. Next is dividends paid. For this, let's go back to our cash flow statement. In the financing activity, there should be one line item for dividends, payment of dividends and equivalents. Here we could see historically how much the company have paid. That is, in 2023, they have paid 15,025 minus 15,025 minus 15,234 and then minus 15,421. So these are the historicals dividend the company have paid. Then might be before calculating what will be the next 5 years dividend, let's also try to put the share repurchases. Then we will try to forecast it together because it has a lot of commonality. In 23, they have made $77 billion of repurchase, 77,500. Sorry, it's not 500, it's 77,550. Next year, 94,949. Next year, 97,11. Okay, so now we have got the dividends paid and the share repurchases. So typically what is the best practice, or how I would do is consider what is the payout ratio. Payout ratio is nothing but how much dividend they have paid and what is their net income. That gives us a percentage. That percentage is the payout ratio. We'll try to see what was the last 3 years payout ratio and try to average it over the next years. So what I will do is now something called payout ratio, which is nothing but dividend by net income. So now we'll do this. Might be just here for the cash flow statement we have dividend in negative, but for this calculation it doesn't make any sense. We'll have it in positive, so I'll just add a negative. Divide this number by our net income is already here. Okay, do that for the next 3 years. Maybe I need all these items in percentage. I'll come and change this to percentage. Okay, we could see for the payout ratio for the last 3 years is 15.5%, 16.2%, 13%. That's a good number. I mean, the company is giving back to their shareholder. It's easy enough to consider as an average of last 3 years. The company will be paying the dividends as next year, which says 15%, which is still a reasonable number. But the story flips when we consider the share repurchase. Historically, Apple spent a lot in repurchasing their own stock. If that is the case, let's try to consider how much they have repurchased. So that is repurchase divided by net income. Let's do the same how we did for the dividends. So now I'll do this number divided by this number. And then do this. I will have this as a percentage. Now even we could say simply that the repurchases can also be average of last 3 years, and then that numbers will go or hold true for next 5 years. But historically, if you look at in the year 2023, they have spent 95% of their net income in payout ratio, I mean dividend and the repurchase. In 2024, they have spent 117%. That is way beyond what they have earned as a payout to the shareholders. Then in 2025, it is again approximately 95%. If we take a look at it, this number seems always to be on the higher end. That's how that's how Apple is trying to return back to the shareholder, either as a dividend or trying to increase the shares count so that the shareholder value will be higher. So as per our assumption, we are taking it as average of last 3 years of dividends and repurchases will continue. Or you could even say, it doesn't make sense to give all the 100% of net income over the next 5 years. I will put a step function. Say might be the dividend payout ratio can be 10% for the next 5 years, and share repurchases say can be 50% or 40%, or you can even assume Apple is not going to spend anything on repurchases. But in my opinion, historically, Apple have given a dividend at least for the last 5 years, 6 years. I've been holding the share. I don't see the dividend is getting stopped unless until some direction change or any high level executive change comes in. And similarly, I see the repurchases might also happen, but I fear it might not be on the same level of what have been done in the last few years, but still there will be some repurchase. But since we don't have that level of nitty-gritty information, we'll just go with the last 3 years average and forecast what will be the dividends and the net income. Sorry, dividends and the repurchase. So now 15% of this value will be given as the dividend. I will just add a negative because while we do this, we will give a negative number. That's it. Now we are done with this. And repurchase, we are saying 80% of their net income is going as a net income. Just have a negative. Okay, now we got these two guys. Then new debt taken. This one is, we don't need to spend much time because we already did the debt schedule. In the debt schedule here, which we did for the balance sheet, we have considered Apple is not going to take additionally any new debt, but realistically it's not going to be the case. They will take a new debt as and when the interest goes down. They can get very cheap rate of debt. But for now, I'm just considering there is no new debt. I'm just going to use the same value here. That is zero debt, but I'll just copy here so that in future if I just want to change the debt, it will automatically link here. Then the debt repayment. That is, we know or we understood from the footnotes, Apple is going to pay these many amount in the next 5 years as an interest payment. So this will be the same value which will come into our debt repayment in the cash flow from financing. That's it. Then now cash flow from financing is simple, just adding all these 4 line items. Okay. Then finally, cash generated by end of year is nothing but summation of this guy plus this guy plus this guy. Okay. So I think this pretty much covers what we need to do for the cash flow statement. In the cash flow statement, as of now, we have 3 open items. The first open item is the depreciation and amortization, and the next 2 items are purchase of property, plant, equipment, and change in non-working current assets. So once we do these 3 items next, we can consider cash flow statement is done. Then we'll just input, or we can see what to be done for the 4 missing items in the balance sheet. So in the next video, let's come back, or the next part, let's come back and start building a schedules for all these missing items and wrap up our model. Okay, now let's continue with building the individual schedules for whatever items we have left open in the cash flow statement, like depreciation, amortization, purchase of property, plant, equipment, change in non-working capital assets. So I would typically start with purchase of property, plant, equipment, and figure out what has the change. How much the company have invested in the past and how much the company is expected to invest in the future. So for this, first let's go to the cash flow statement and figure out in the past how much they have invested. Okay, purchase of marketable security. Okay, this is the line item we are looking for. Payments for acquisition of property, plant, and equipment. So in the year 2023, they have spent $10.95 billion. Might be we'll start inputting that number here. Then in the next year, they have invested $9.4 billion. Then 12,715. Okay. And one more additional information might be once we take a look at any property, plant, or equipment, there will be some sort of depreciation tied to it. Even though we have depreciation and amortization as one line item in the cash flow from operation, it doesn't it's not an exact value which we are looking for depreciation, because depreciation will be for the PPE and amortization might be for the non-current assets. Once I read through this Apple's annual report, they have specifically mentioned what is the depreciation with respect to just the property, plant, equipment they are having. For that, let's go to the footnotes. Maybe I'll just type in depreciation. Okay, so this is the breakdown, or this is the first property, plant, and equipment footnotes which I was looking for. Here you could see in the 2025 they have mentioned they have $49.83 billion. And the most important line item I want here is this one. It says depreciation expense on property, plant, equipment was $8 billion, 8.2 billion, $8.5 billion during 2025, 2023, and 2024. So out of the total depreciation of $11.6 billion in 2025, just $8.5 billion is coming from a depreciation of property, plant, and equipment, and rest of the depreciation value, which has not been explicitly given, but it is a best assumption to take all the other depreciation is coming from non-current assets. So now, since we got this information, let's first try to understand what is the property, plant, equipment future. I mean, what is the forecasted property, plant, equipment spending? For this, first, what I will do is I will capture how much depreciation related to PPE. That is the first thing I will capture. That information we already have from this footnote, which is in 2023 it is $8.5 billion. Then in the next year it is 8.2 and then 8. So now I got the depreciation, but what I need to understand is how much it has depreciated compared to their total assets. Might be what I would do is, we already know what is the total property, plant, and equipment value that is coming from our balance sheet, that is here. For the last 2 years, we know this is the total property, plant, and equipment. With this, I will try to understand what is the depreciation percentage happening. Then I will take average of these 2 years depreciation and forecast the same depreciation is expected to happen in the next 5 years as well. So now what I will do is PPE value, which is going to be this guys, these three guys. I know for 2023 we don't have the value, so let's find. Now let's calculate depreciation related to PPE as percentage of total PPE, which is just dividing these two guys. And then do this. I want this one entirely in percentage. Okay, we can see that approximately in the year 2024 the depreciation was, maybe I'll just put in the years so that it's not confusing or I'm doing some random thing. Okay, in 2024 the depreciation of PPE is around 17.9% and in 2025 it is 16%. So as a simple assumption I will take for the next 5 years, the average of these two numbers will prevail, which is approximately 17%. Okay. I'm just thinking. Okay. So the next one, now let's start to build the proper property, plant, and equipment schedule. So I will just put this here. Property, plant, and equipment schedule. Okay. So BOP, that is beginning of period property, plant, and equipment, plus additional spend on PPE, which is nothing but the CAPEX, less the depreciation related to PPE, and then end of the period PPE will happen. So now to start with, we already know what is the end of period PPE for the last 2 years. That is these two numbers. Then the simple assumption is last year's beginning of period is the next year's, sorry, last year end of period is the next year beginning of period. Then for the next 5 years, the simple way is to calculate, to calculate the end of period is sum of beginning of period plus the addition subtracting with the depreciation. So this is what we need to do. Now, what we can do is simple thing. We need to forecast what is the capex percentage. By end of the day, in my opinion, it's better to take or calculate how much capex the company have spent as percentage of their total net income. Similarly, how we did for our dividend and the repurchase. So the same analogy I will do. Capex by net income. So we know the capital expenditure for the last 2 years is, we already have numbers for 3 years, so we'll take it. So capex for 2023 is this value divided by the net income which we have here. Might be it will come in negative because in the cash flow statement it is in the negative, so I'll just make it as a negative, and then I will do this. Then make this row as a percentage. So the understanding is Apple in the last 3 years have spent on an average 10.91% of their net income into capex. Let's assume the same assumption that they are going to spend again 10% of the capex, 10% of the net income as the capex. But if you really feel that 10% is too low, capex will significantly higher due to the AI, because some company like Google, they have explicitly mentioned they will spend around $75 billion in the next year on capex, but nowhere officially Apple have mentioned what is the capex spend going to be the next year. So with the available little information, I'm just taking, it will be like 10%, 10.9% of the net income will be the capex for next year. So with that information, I will just calculate for the next 5 years for 2026, 10.9% of their net income is going to be the capex. Done. Then the next one is depreciation related to the PPE. Even here, I know initially we calculated the depreciation related to PP as part of total property, plant, equipment they had. But unfortunately, we don't have that number, that is the total property, plant, equipment to calculate it. I will even consider the depreciation related to, PPE as percentage of their spend on capex. Spend on capex. That is, if they spend, it might not be the exact number, but with the little assumptions, I think it might make sense. So now we know what is the depreciation for the last 3 years. That is from this number. Sorry, this is not the depreciation. The depreciation is this number divided by the total spend, which is this thing. I'll just estimate it for the next 3 years. Maybe I'll just remove these three guys. I need to add a negative in front of it. Okay. So we are saying that for the last 3 years, on an average, how much capex they have spent, approximately 75% has been depreciated. So we will take that as an average. Then that will be the number which we would see for the next 5 years as well. Now let's take 75% of the total capex spend is depreciating each and every year. That is the number which we are going to put in here. Since the depreciation should be subtracted from this BOP, I'll just put a negative sign there. Then I will just extend this. So now by doing this schedule, what we got by end of the day is what is the end of period of property, plant and equipment. So we'll just put a border. So basically what we can do is take this number and provide as an input in property, plant, equipment here. Maybe we will just tag this number here and say we are got this number which is equal to this numbers. Okay, this part is done. Then we got what is the depreciation related to PP, and similarly we need to get what is the depreciation related to non-PP item, which is non-current assets. For this, historically, let's calculate what was the non-current asset depreciation, and then take the same analogy what we did here and forecast the same percentage of average in the next 5 years as well. So first, let's calculate what is the D&A not related to PP. So we know what is the total depreciation for the last 3 years, that is this numbers, and we know what is the depreciation just with respect to the PP, this number. So just by subtracting these two, we will get the value what is the D&A not related to PP. First, let's get that number. This one minus this one. Let's do that extended for the next 3 years. Then what we would do is non-current assets. Our simple assumption, because Apple haven't explicitly mentioned what other depreciation and amortization are, I'm taking an assumption that it is entirely coming from the non-current asset. So we know what is our non-current asset from our balance sheet. Non-current assets is this number. So we'll just forecast it. I know for 2023 we don't have that number, so let's take it off. Now let's calculate again how much depreciation have been done with respect to the total non-current asset. I will do the same D&A over non-current assets. So by doing so, just divide these two guys. Make this as a percentage so that I can see what is the percentage. So typically it's just around 4.3% or 4.4% is the D&A related to non-PP. So I will just take that as an average. Do the same. So now we estimate approximately the depreciation and D&A related non-PP is 4.3%, and we will try to multiply this number with the total non-current asset which we already estimated. That way we will get the amortization related to non-current assets. So let's do this. Get this number. So now we already have got what is the depreciation related to PPE. Now we already got depreciation not related to PP. By doing sum of these two, we will get what is the total depreciation and amortization. That will be the input of this number. So we will just do this number here, then calculate that as this number plus this number, but still I'll add a negative sign because they're all already a negative there. We will come to this one. Okay. So as per our numbers, we are saying, even though the last 3 years the depreciation is somewhere around $11.5 billion, based on our numbers, the depreciation and amortization for the next 5 years is going to be significantly higher. But still, let's stick to that numbers. Now we got this number. Then what we can do is, since we already calculated the entire PPE value here and input the numbers, we can see how much the company has spent on PP. That is, in 2026, we are saying the PPE will be approximately $53 billion, but in 2025 it is $49.8 billion. So basically the difference between the two numbers is basically what the company have invested as a PP. Now let's come and input that number here. So which is going to be negative of this number minus this number. Okay, we are just saying Apple is going to just spend $3 billion in the next year in purchase of PPE, that is how our assumption is coming. No, I think this is where we need to be very careful in inputting this. Technically, what we need to do is, it's not a difference in the purchase of PPE. Purchase of PPE is nothing but the capital expenditure. Capital expenditure we already have from this schedule, so this is the number we need to input here. If we do that, we could see in the last year, that is in 2025, it was around $12 billion. From the next year, it will be 13.7, and the number goes on. So this is good. Next, what we need is this guy, which is change in non-working capital assets. Might be the simple question which you could have had is, we already have other non-current assets here. Why can't we just take a difference between these two numbers and put it here and proceed? Unfortunately, it's not that simple. The reason is um, this depreciation and amortization. We have considered the depreciation and amortization in two fronts. One is from the PPE front and another one is from non-current assets. If we just do the difference of that value, we are doing a double count of depreciation and amortization. That is, we already captured what is a D&A here. If we just take a difference of other non-current assets and put it here, this will again include the depreciation and amortization. So we will build a separate schedule for this and calculate what is the actual money spent on non-working capital assets or non-current assets. That schedule will also be similar to this. Let's do that. Other non-current assets. So BOP, non-current assets, plus addition plus new non-current assets, less D&A related to non-current asset, then end of period non-current assets. We know what is going to be the end of period of non-current assets. That will be just this number. No, for 2023 we don't have it, but that's absolutely fine. Let's take this off. Then previous year end of period is next year beginning of period. Let's do that here. Then we already know what is the D&A related to non-current asset, that is this number. But make sure while it comes here, it should be a negative because we need to subtract that one here. So we'll do this. So now we know already what is the end of period. We already know what is the beginning of period, and now we have depreciation amortization. Now we just need this number. Now it is simple algebraic formula. Just do the difference between these three guys, and let's come to that number, which is this one minus this one minus this one. So let's pull this forward. So if we do this summation of these three numbers, it should come to this equivalent number. That is, in the beginning of period, they had $83.7 billion, plus they have added $11 billion on non-current assets. Then out of that, there is approximately $3.98 billion of depreciation. By this way, we know what is actual dollar amount spent on non-current assets. So this is the number which we will provide it in this section. So we'll do that. So which is going to be this guy. Make sure, since this is an addition here, I mean amount went out of the company, while that goes into the cash flow statement, it should be a negative. Then just pull this out. Okay, so pretty much we have completed all these statements, I mean everything in the cash flow statement, and we finally got the total cash generated. Whereas in the balance sheet, there is still four items: cash and cash equivalents, which is just nothing but the output of the cash flow statement will input here. Then commercial paper, we will do it next, and then stock, common stock, APIC, and accumulated deficit. Okay, I think I just realized one thing. Since we have commercial paper as one line in the balance sheet, the same line should also come and reflect in the cash flow from financing. Might be I'll add one line item here, just put commercial paper, because by end of the day, if I didn't do it, the model won't balance. So I will just do the same color coding here. So now typically we are just left with commercial paper, common stock APIC, and accumulated deficit. So commercial paper, let me ensure this was 99 to 103. Okay. So first we would link this one. So based on our calculation, we are just saying Apple is just going to generate $1 billion by end of 2026, even though they generate $400 billion as a total revenue, $100 billion as a net income. After all their other expense, they will just have $1 billion. But still, that's fine, because if you take a look at our previous year cash flow statements, not this one, not this one. Okay. Okay, so what they have mentioned is in the year 2025, they have just had total cash generated is around $5.9 billion, and in the previous year they have lost $794 million in the entire operation. Then just even year before that, they have just made around only $5.76 billion. So I think with these numbers, whatever numbers we have got for the next 5 years seems reasonable. I will just input that number in the cash and cash equivalents. So while doing so, we need to be very careful. What we are saying is by end of 2025, they had approximately $35.9 billion. Then in 2026, we need to add this amount plus the total addition we are forecasting the company to make in the next year. Please ensure this is done right, or else there will be some hiccups or there will be some issues in your model by end of the day. Okay, this is done now. Now, let's talk about commercial paper. So commercial paper, as we briefly discussed, it is nothing but a short-term borrowing the company can take. Let's first try to understand. I mean, just by taking a look at this number, in the last 2 years, they have around $9.9 billion and $7.9 billion as a commercial debt. Whereas they also mentioned they have approximately $30 billion and $35 billion as a cash. So first, let's take a simple analogy and understand the revolver concept, because by doing this financial model, whenever this commercial paper comes up, the revolver analysis comes into picture. I'll do a revolver analysis now. This revolver analysis by end of a day will be kind of a plug to the company when the company needs extra cash for their operation. So what I'll do is cash at beginning of period, which we can get from the cash flow statement. Then cash generated during this period, which we can get from the cash flow statement. Then even some of these two numbers will get how much cash they have, and let's see whether they can entirely pay off the debt. In that case, most of a company, even though they have well beyond the cash they need to pay as a commercial paper, they won't do it because they'll get debt at a cheaper rate. Even in the Apple's annual report, let's see what was the interest rate for the commercial paper they're saying. Commercial paper. Okay. So in this footnotes, if you could note, the weighted average interest rate of company's commercial paper was 4.19% and 5% as of 2025 and 2024. In 2024, the interest was 5%. Now it was just 4.19%. And as and when Feds cut the interest will get lower. So they get interest like well beyond 4% going forward. So most companies, they will like to take the commercial paper debt. So but before taking that, they would like to have some minimum cash into it, because they, even though they have all the money in the world to pay and close off the debt, they won't do it, and they would like to have a minimum cash balance. So let's assume what was the minimum cash balance which Apple would like to hold, which Apple would hold. Then we can say total cash available or draw to be done. So now first let's input. Might be this will be a bit confusing, but as we progress, it will Hopefully it will be clear. So cash at the beginning of period is nothing but cash at the last year's end of period. So we'll go here and then input this number. We had this much of cash. Then cash generated during this period, which is nothing but this amount. But technically, if you put this amount, it doesn't make sense because the commercial paper we haven't added it. By end of the day, once we add in commercial paper number, this number will increase or decrease. So what I would do is, rather than just taking it, I will just type in CFI, I mean cash flow from operation, cash flow from investing, plus cash flow from financing, except revolver, except revolver or commercial paper. I'll just commercial paper. So doing so, first is CFO, which is this guy, plus this guy, plus this guy, plus this one, plus this one, plus this one. So now we will get the same number as 1018 here, but after we plug in the commercial paper, this number will change. So I don't want to do that as of now. That will intentionally blow my model out. So I'll see what is the next 5 years. Okay. Then the minimum cash balance. So the minimum cash balance might be by end of a day. It's an assumption value. You can even say the company would like to have say $5 billion, $10 billion. As an Apple as a company, it's a very huge scale. So I'm just assuming as of now they would like to have $10 billion as a cash at a very minimum level at any point in time. That they wouldn't even they go whatever situation happen, they wouldn't take out that money off. So this number should be a negative one. So now we know they have this much number as a uh, cash available, out of which at any point in time they won't even let go this $10 billion below this $10 billion mark. So we will do this numbers as a summation of these three guys. So now we would say that the total cash available to pay down their debt is 26.9 billion dollars, whereas they only have a debt of commercial paper is only $7.9 billion. So with this, now let's build the commercial paper schedule. So in this, what we would do is, let's calculate the commercial paper. BOP, cash paid, on, then commercial paper BOP, end of the period. So we'll do this. Then this is just going to be sum of these two guys. So here, the company, I mean, Apple have $7.9 billion which need to be paid as in commercial paper, but they have $26.9 billion. So let's, to be very dynamic, rather than just inputting the number, I will just say what is the minimum of this two value. We will input that number here. And since this is a cash to be paid, which that will go out of a company, I will just put it as a negative. Then I will do the same for here. So this is how it will work. They might be then we are saying that hypothetically Apple decides that, hey, you know what, whatever happens, I need to have at least $50 billion of cash. Then in that case, the company need to take or need to draw extra of $13 billion. If that is the case, even though the commercial paper is $7.9 billion, they don't have any cash to pay out the debt. They will take additional $13 billion from as a commercial paper. That makes the end of period commercial paper to $21 billion. Then in the next year, if they change their mind and they say, you know what, $10 billion is fine for me, then they can repay the loan. But hypothetically speaking, $50 billion is too much. I will just stick to $10 billion. Then the next line item I will add is this one. What if the company says, you know what, I'm just getting interest at getting debt at very low interest rate. I will take additional commercial paper. That is the new commercial paper which the company can take. Apple can come and say, you know what, I'm getting interest at 3%, so additionally I'll get say take $10 billion as an additional commercial paper loan. In that case, I'm just putting a forecast of $10 billion. Something doesn't look right. I think this guy. Okay, this should be rather than this sum of these three rows going forward. Then that should populate here. Now we are saying that the commercial paper is the company is taking additional $10 billion loan every year. Then this is how the end of the period commercial paper will look like. So now we got this number. Might be if you think Apple won't even need to take any commercial paper, then just make this line item as zero, or they might take additional $5 billion every year. Let's do the same accordingly. But for me now, I'll just assume they will take additional $10 billion each and every year. So we would put this numbers here. So we got what is the end of period commercial paper for next 10 years. That is an input going to be done. No, not here. Here it is. Okay. In the balance sheet, we will put that number. This is going to be $10 billion. Then in the commercial paper, in the cash flow statement, we will just calculate what is the difference between those two numbers. Then we'll put it there. Perfect. So now we only left with two items, with the common stock APIC and accumulated deficit. We'll come to that final part. First, I think I already talked about this, but let's revisit it and understand what does it contain. Total assets. So the accumulated deficit and common stock and APIC will come under shareholder equity. If you scroll down, you could see the total constitution or what does it consist of. Accumulated deficit, they start with their beginning balance plus net income plus their dividends plus their common stock withheld related to the equity awards, which we don't know what will be the exact number, so we are not going to consider this. Then finally common stock purchase. By doing this, we will get to know what is the total ending balance of accumulated deficit. So let's do this. Then similarly, for the common stock and additional paid in capital, they start with beginning balance, common stock issued, which is the new stock issued. In our case, we are not considering it. Then common stock withheld related to share equity awards. This is also very minor number, which we haven't considered in our modeling. So we will leave this number out. Then take only the share-based compensation. By end of the day, doing this, we will get the two more additional number which we need. So let's start with this one, which is accumulated deficit. Deficit BOP plus net income plus dividends plus repurchase, end of period. So we know what is the end of period value. That is this guy. The end of period value will be this number. Next year beginning is end of previous year. We'll do this. Then We know what is the net income for the next 5 years, which we already calculated. We'll go to our net income, put that here. Then in the dividends, we already calculated in the cash flow statement. That is this guy. Then repurchases, we already know what is the repurchase, which is this number. Okay. So now we just add all these four guys to get what is the end of period amount. Then just pull this forward. Okay. By doing so, we are saying that this will be the accumulated deficit value for the next 5 years. Then the last one in this module is the common stock and additional paid-in capital. Common stock and APIC. I'll call additional paid-in capital as a short form. Again, the same thing. Beginning of period plus share-based compensation and end of period. So we know what is the end of period of the common stock from our balance sheet. That is, this number is here. Then this value is equal to previous year end of the number. Then just pull it forward. Now we know what is the share-based compensation that we can get from our cash flow statement. Cash flow statement, here we have a share-based compensation. Then just put this number, and end of period we'll get it by adding this guy plus this guy. Just pull it forward. Okay. I think we have got all the informations now. We will just plug in these two and see if our model balance or not. Hopefully the model should balance, else we will figure out what is the issue with it. First is common stock. Common stock is this number. This number is this. Then the end of period, this one. Perfect. By doing so, might be I'm not sure if you have noted, before we inputting this number, it is not balancing. After we put our accumulated deficit from the calculated value, that is this number, the model finally balances out. So as of now, if you have followed all this process along, your model will be a perfectly balanced three-statement financial modeling. So now we can do two more modules. Till now its financial statement model is done, but to make it more complete or more user friendly, let's do now sensitivity analysis. So what it means is, as I promised before, this model will try to consider what is the bull case scenario, what is the bear case scenario, and what is the street case scenario. Or sometimes it's also called as best case, weak case, and base case. So now let's say here we have taken some assumption. Say we just mentioned product COGS is 63%. What if might be, as we know, recently the production have been moved from China to India. In India, the production cost is higher, then this number will go significantly higher. How to account that? Then similarly, we have mentioned SG expenses 6%. What if it goes up to 7% tomorrow? Or what if in any best case the number goes below that 6.6%? So to encounter all these three things, all the items, we will construct our bull case scenario, bear case scenario, and street case scenario. So for this, let's come here and start doing it. First, I will consider, I'll take three items. I'll just do this. So sensitivity, or I would say sensitivity, or I will just call it as scenario analysis. So I'll just, for this exercise, I'll just take 3 example: product COGS and R&D expense. Maybe I will just copy paste from there. I will tell you why I do this. Not this one. Okay, I will take this one, which is product COGS, R&D as part of total revenue, SG as part of total revenue. So I'll just take these 3 guys. Just copy this and put it here. And then this one, product COGS. So we will try to calculate for each and every scenario. That is the 3 different scenarios. What will be the value? I will just color code it for now. I'll also do one more thing. I will just pull it down further and just consider the scenarios or cases. As we know, there can be 3 cases. One is, maybe I'll, before that I will just do this one as well. Product COGS. In product COGS, there can be a bull case or base case, then street case and bear case. Then the similar thing applies for this one. Things, the 3 things I'll paste it, and then I will come here. There is a typo. TOTAL, total revenue. Okay. Just do this. Just do this. Okay. So we will start putting these 3 options. And as I mentioned, there is 3 cases. So we'll put a list. There is a better way to do this. I'll go here, go to this data validation. Instead of any value, I'll put as list sources. Rather than I type it, I'll just do this 3 selection. Hit OK. So now you could see it will be kind of a drag and drop thing. Like I can just say either this one, but nothing changes if we pick anything because we haven't built anything here. So now we will start providing the values here. There is a street case of product COGS we did is 63.18 for all the 5 years. I'll just type in that value. Maybe I would need everything here as a percentage, so I'll first make this format right. Home percent. This is 63.18. Please make sure while you are doing the sensitivity analysis, don't link anything directly from our income statement because that will end up in coming up a circularity. Then R&D is 8.04%, SGA is 6.6%. 8.04, and this is 6.6%. That's it. Okay, now let's start to build the bull case scenario here. So this is the street case. That is whatever we build our model as of now. Consider that as an assumption. Now let's try to see. As of now, Apple is as per our forecast, we are seeing that Apple will be spending 63% as a COGS for the products. But what if the best case is they doesn't need to spend 63%, they can just only spend 60% of COGS or even further. And then the bear cases, after moving the production from China to India, the cost increases. Rather than 63%, it will be going forward 70%. So the better way is we can just say, based on our educated guess or an assumption or from your experience on the numbers, you can just try to put an input. Say I will just say the best case will be 60% will be the COGS. Then the bear case can be say 70%. Then I will just do this one. Or then next comes to the R&D. When it comes to R&D, you could say that the best case is the company might not even spend much on R&D. The maximum they could spend is only 7% of the total revenue. Then when it comes to beer case, where they spend a lot of money, especially on this AI, we don't know what will happen. We can say, I'm considering there can be 10% of spend. Not necessary you need to consider the same value for each and every year. You can say 10% for the next year, then next year it's 11, next year it's 12, next year it's 13, and next year it's going to be 14. So either number will work, but whatever number you pick, just be consistent. And similarly for the bull case as well, anywhere it's not necessary to consider the same number here. Then coming to SGA expense, I'm saying that the best cases it can go up to 6%, and then the bull cases say it can go more, say around 7.5. From here I can even say, what, it will be 7.5 in this year, then next year I think I did something wrong. 7.6%. So based upon your best guess or understanding, you could input numbers here, but make sure the number is not going too much off board, because if you do switch anything here, that will drastically going forward impact this. Or else what I have seen is they will also give some variance here. The variance is 1% or whatever number is, then just add and subtract 1% to the get the bull case and bear case. But for now I will stick to this number. This is what I'm saying might be the most reasonable, but this number could be challenged or argued. That's absolutely fine, but I will stick to this number. So now what we need to do is, if we need to fill in this number, because by end of the day I will just going to give this number as an input in the income statement that will dynamically update it. So now I will just say cases as a switch. If I make this as an, say, I'll just put this one as an active case. So active case is nothing but here. See, if I pick street case here, what should do is I should get all the numbers from here. Okay, first I'll make these guys as a percentage. Then if I do this, I need to get in this number, and then I need to get in this number. So this is how it should work like. But now if I move to street case to bull case, nothing happens because it's not dynamically updated. For this, what I will do is I will write an offset function to get this done. Might be some of the people will be familiar with this offset, and I will also use match function. I will tell you, might be it's not that intriguing thing to do so, but still I will get it done quickly. Offset, I will use reference as this one, and then I will do rows. If I need to get this rows, I need to go 2 rows down, but it need to update dynamically if I go from this line to this line. So I will use this match function. I will look up for this value. No, I will look up for this value. I will put this as a constant, then look up in this guys, then look up for an exact match. Then column, I don't need to go down, so I'll just put this number. So I will just populate this. Okay, I think I missed something. Got it. I need to be anchored. Okay, so I'll just expand this. Now hopefully if I switch from this street case to bull case, the number should change. Okay, it changes to 60%. If I switch from this, it changes to 70%. And we could do the same thing. Maybe if I do drag and drop, this is not going to change me because that function is not going to help us. So what I will do is, again, I will do the same. Lookup, sorry, offset. Reference is going to be this point. Then the row is going to match with, let me do one thing. I will come to first street case, offset, reference is this number, rows will be a match function of this lookup value in these guys, which are match type of 0. Then as and when I go down, I need this should also be looked up. So I will add another match function. That's not another match function. I'll just put plus match this variable in this lookup, and this no, match this guys in this lookup of this array for an exact match of 0. Then I will add a -1 and then columns is 0. I'll just put this as well a constant. .04, so I will just nothing works. Why? Okay, I put anchor in C178. This should be anchored. Okay, this should be an anchor number. Then if I just pull this in, now again it's not open. C178 and then 183 to 194. Okay, let's pull this and see why it's not open. Okay, I think the issue is here. We also need to put an anchor number here because this is also moving. Okay, this is also an anchor because this should stay constant. Might be, this is an lazy thing to do, but I feel this is the most critical thing. So now if I change from street case to bull case, yes, the number changes for both. Then even this number changes. Okay. So now I'll just copy paste this guy here. I think I just need to change few items. Instead of 183, it should still be 183 because this is my offset row. And then instead of I anchoring 175, yes, it's 175, look for this, and then 179 through. Then rest of the things should look same. Okay, this is a bull case. Then might be now if I switch from bull to street case, it changes. Perfect. Okay, if it is a bear case, we have mentioned product COGS is 70%. That comes up here. R&D is 10%. That's the same number we have given here. And if it is SGA, it is 7.5% to 8.5. If we switch it, it works. Might be this offset function, match function is a basic Excel thing, so I didn't talk much here. I just did it quickly, but take a moment and you guys can work on this one. So now what I will do is in this column where we have gave the SGA and others as a number, rather than this, we will just give what we calculate as an input here. Might be while doing that bull case analysis, you can take any number of variables rather than you can even consider tax rate. Tax rate we are saying 16%. What if the tax rate for next 5 years is 18%? You could consider that as an assumption. And one basic thing you would have is why not we haven't take the revenue growth. You think about it, with the approach we did, we can't do sensitivity on the revenue growth. Let me know if you really understood why you couldn't do the revenue growth sensitivity analysis here and what can be differently done. to also sensitize the revenue growth. Now I will plug in what numbers we got there. I will just, rather than, I mean, right now we got average of last 3 years. I will do this. So go here and I'll just plug this number because this is the numbers I need to use here. 63.18. Okay, I will just formulate this. Then R&D rather than average, I will just use this because by end of it, if I change that switch from street case to bull case, I would see the numbers change. I will show you quickly in a minute. This is done. Then similarly, SG expenses this way. Okay, this is also done. So now we'll switch to, this is street case. Might be I'll do one thing. I will put that scenario here. Case is this one, which is nothing but the same thing which we did put there, because if the list is here, it will be easy to switch and see how the numbers change. So I will put these three guys. Then what I would do is, this is the number which is coming here. So I will change this because I would like to have that case there. Might be if you could come and see here, it will say the case. So now I will just link this row D3 over there. So if I change something here or switch from full to straight case or any cases, you could see the numbers change here. So it is D3. I will change this. This should be D3. No, it's D3. Okay, save this one. And I think now it is not needed. You can even delete that row. So now if I go from, maybe you could note, as per the street case, our net income for the next year is $126 billion. But if I go from street case to bear case, it changed. It's only $96 billion. Then if I switch from this bear case to bull case, you could see the number goes from 120 billion odd dollars to $141 billion. So in this way, we are confident that our model is also sensitized to three different cases. The three different numbers which we use to sensitize is product COGS, R&D, and SGA. You could even do the same with tax rate or any other metrics from here. But some of the metrics we can't do it. I hope you understood or you found out why we can't do that one. So I think this is what I would like to do in the sensitive analysis. Then the final part is this one, the total net sales. The total net sales, if you recollect from the beginning of this video, I just got the number from Simply Wall Street and provided that number. What is the other way I would do, or what way I will feel more confident is, I even calculate for each and every revenue segment what would be the total revenue. I'll show you how and why it makes sense to me. So I'll just copy paste these guys first. Okay, then revenue breakdown. Okay, so for this, go back to the Apple and just I will type in some keywords, not this one. Maybe I'll just scroll it through because I know which page it is in. But if you're reading through this first, you can scroll slowly and see. Okay, not this page. Okay, this is what I would like to see. It says Apple here, the number total says $416 billion as a revenue. That is the total revenue which we put in the income statement. This table gives you a breakdown, how much they made from iPhone, how much they made from Mac, how much they from iPad, wearable home and service, and final sector is services. So what I'll do is, I will take my own assumptions on what I see as a next 5 years growth for individual segments and provide that value as an input to the income statement. So that way I'll feel more confident on the total revenue which I calculated rather than I just taking some assumption from uh, the Simply Wall Street. Even though my assumption could go terribly wrong, but that's absolutely fine because we are only doing an estimates. It's okay to go wrong. So first I will do this. First is our favorite iPhones, Mac, iPad, wearable, home and accessories, then comes services. So let's go here and put in 2023 Apple iPhone sale is 205.83. Next year it is 201 183, then 209,586. Mac 29,357. Then iPad is 28,300. 26,94. 28,023. Then 39,845. 37,005. I'm just inputting the numbers, nothing special I'm doing. 35,666. Then finally it is 85,200. 96, 169, 109, 158. Okay, so now let's calculate the total revenue, which is sum of these for all 5 items. Let's do quick sanity check if we got the numbers right. 2023 it is 383,285. Next year 391,035, and finally 416,161. Okay. So now also Apple have provided what is the change between each and every year or year over year growth for each and every segment. I will again capture the same information. Might be I will put this as dollar value, and then next one as maybe I don't need this guy. Then this is YOY change. Year over year change. I'll just copy paste this guy. Then do the same. This is this much minus this much by divided by this guy. I will just put all these numbers in percentage, and we won't get numbers for this because we don't have the previous year, so I'll just format this accordingly. Fill pattern this one. Okay, so I will do this numbers, and similarly I will do this one. Okay, it looks like there is a negative, but let's ensure. Wearable home accessories. I think I have made some mistake here. Let us see. P200 minus D minus D by D, that's right. But why the heck it's not matching? Oh, my bad. Okay, wearable home accessory is here. Okay, in 2023 they made 39 billion, but in the next year they only made 37 billion, so that's why you are seeing a negative. And in the next year it says even negative. Okay, the negative trend continues. So I think, yeah, pretty much I have got all the numbers. Then finally, year over year change on total. I think it doesn't make any sense, or we already got. Okay, we'll put it and see total revenue YOY change. Okay, so now what I'm thinking right now, iPhone, I really don't know if will grow at the same 4%. I mean, even though, I mean, I think, okay, I will come to this thing. They just launched their iPhone new model. I think it's 17 version last month. Even though the sale looks good, but I really don't know will it go beyond like 70%. So to be very considerate, I will consider maximum of 5% of the iPhone sales year over year for the next 5 years. or at least for this year, I'll just consider 5 percentage. For the next year, I'll consider 5 percentage. Then after that, I'll just consider 4. Again, this is just based on what I understood from Apple business. If you think otherwise, or you could come and argue and say, you know what, from next year, iPhone sales will be 10 percentage year on year growth higher. That's absolutely fine. You can put in the number, or you could say it won't even grow. That's also absolutely fine. You can just put in this number. Then next one is Mac. I already did one fundamental analysis where Mac is literally struggling to maintain its revenue. So I really don't know if they would be able to sustain this $33 billion of growth. I wish they sustain, but realistically speaking, I don't know. So I will just say negative 5 percentage, not this, negative 5 percentage for next year. Then from that year, I will just put 2.5 percentage and 2 percentage as a growth. Then next one is iPad. iPad is also literally kind of struggling. If you see in 23 to 24, there is a decline. Then there was a steady growth, but still, I would say 4 percentage. I'm expecting 4 percentage of year over year growth. Then similarly for wearable home and accessories, in the last 3 years it's declining, but I hope they maintain this sales over the next 5 years. So I'm just not putting any addition or reducing it. But I'm pretty confident the service, because service, once we subscribe it, it is more of a recurring revenue. So I'm considering at least 12.5 percentage of returns over the next 5 years for all the revenue segment. With this, I will calculate each and every line items mm, dollar generation. I'll just put this number, multiply it with 1 plus this guy, which will give me some dollars, and then this number, multiply it with 1 plus 5 percentage, and then this will give me this number. Then this number, multiply it with 1 plus this number will give me this one. Then finally this number multiplied by this. Mm, I will do this. Okay. So by doing my analysis, I could see for the next 5 years, this is the total revenue, and this is the year over year growth rate. I think if we look at what we consider as year over year growth rate, uh, we have mentioned 8.73 in the next person, then approximately 6 percentage in the next 5 years. But as per our numbers, or as per the numbers which I am seeing, even for the next year, that is 2026, I'm just saying it will grow only 5 percentage, and then in the next few years, it will go like 6 percentage approximately. Even here, for this revenue breakdown, you could do the sensitivity analysis as what we did here. Even here, you could build for iPhone the bull cases, it can grow double digit, and bear cases it will stay constant, and services bull cases it can go at 20% and others, and the service bear case is 10%. You could do that, but just for this exercise I'm not going to do this. I'll now what do is plug these numbers into my beginning of the first line of the income statement. So rather than I just hard coded these numbers, that is these 5 numbers I hard coded initially from Simply Wall Street. Now I'm just going to plug in this number here. This guys, okay. So once I plug in, automatically the rest of the things changes, because these two items, which is, or even I can do this one. So rather than if you remember, I have mentioned that yeah, in 2025 Apple have generated 73% of revenue from product. Next year it will be only 72%. Like we used step function and reduced it. Right now we also got what is the total revenue sales from our calculations. I'll just put that here. So I'll feel more confident on what numbers I'm going to put in, because by end of the day you could say it is going to be garbage in, garbage out. Whatever number you are giving in, that's how the numbers will be. So I will give what is more equivalent, or what number I feel more confident, even though it's terribly wrong. It's 100% fine for me. Okay, so let's ensure a sanity check. 439,712,46804. Okay, all this number matches. Okay, so with this, pretty much this video concludes, or the financial statement modeling concludes. If you learn something new from this video, please consider liking this video and subscribe to my channel. If you have any questions or comments, put it in the comment section. Next, I will start using this number as an input to do the discounted cash flow for Apple. Let's catch up in the next video. Till then, take care.